Welcome to this presentation with Napatech. My name is Eirik Thune Øritsland, and with me today I have CEO Ray Smets. So he will give a 20-minute presentation, and then we'll follow up with a Q&A afterwards. So with that, I give the word over to you, Ray.
All right, Eirik. Very nice to be here at the ABG event, and thanks for everyone attending. My name is Ray Smets. I'm the CEO of Napatech. I've been the CEO of Napatech for about 3 years now. And why don't we just jump right in? A little bit about Napatech. It's an 18-year-old company, and we build high-performance FPGA-based SmartNICs. We're going to tell you a little bit more about what a SmartNIC is, but this is an example of one that I'm holding in my hand. It's an important piece of technology that fits within a server. And what it does is it accelerates compute-intensive applications, and we have unparalleled expertise doing that. The secret in here is software, which we'll talk a bit more about in just a second. We are headquartered in Copenhagen, and in fact, all of the engineering is done in Copenhagen from stem to stern. That allows us to maintain a very high quality standard, and we can develop very specific features and functionalities that are unique to Napatech because we're a very close-knit team of employees that have been working for the company for quite some time. So we have a total of about 90 employees headquartered in Denmark. We do have employees around the world. I'll give you a sense of what our revenue stream looks like from different parts of the world. But Copenhagen is a center of excellence for the kind of work that we develop. Obviously, our company started 18 years ago, and other companies have spun off from Napatech. And Copenhagen overall is really a hotbed of technology activity around SmartNIC development. So it's kind of important. We do carry what we call barrier to entry into the marketplace. We have patents, of course, and patents pending. But a real barrier to entry is the ability to create these solutions with the software that runs on it effectively. It's very, very hard, for example, to assemble a brand new group of engineers who have never done this before from local universities and say, go build a SmartNIC. It does take years and years of development to get good at what we do. And therein lies a very important barrier to entry for competition. We have been able to assemble a solid track record in what we believe is a highly leverageable business. You'll see that in the financial results if you do a deeper dive. We'll cover it just very briefly here, but 10 quarters in a row of year-over-year growth, 4 quarters in a row of growth and profit, and we hope that that's a positive sign for our investors. And the good news is we live within a very large and growing marketplace, and I'll give you a sense for that in just a bit too. So that's a bit about the company. Let's talk about what we do. Next slide, please. So Napatech builds very simply a SmartNIC. These are the SmartNICs you see in the center of the screen here. And those SmartNICs accelerate server-based applications. As everybody knows, everything is an application now that runs on a server. It's very, very hard, especially in the world of networking or cybersecurity, to build a special purpose hardware box. Those are times of the past. A transition that the industry went through about 12 or 15 years ago is everything became a software application running on a server. And there are some challenges with servers, and I'll get to that in just a bit. But the SmartNIC itself is responsible for accelerating the applications that run on those servers that require a lot of horsepower. So we design these SmartNICs to offload servers and accelerate applications. And it's really the software that runs on the SmartNIC that powers the ability to do that. And we like to remind our investors that truly is a strategic advantage. We derive a pretty high price point for our products, anywhere between $1,500 and $11,000 per unit. We have very strong gross margins of 70% or more. And that should signal that it's not a hardware gross margin, it's a software gross margin that's really driving the gross margins and the top line of our business, which we're very happy about. And that is by design. We build all of our hardware solutions in the US using a US-based contract manufacturer that we have a very close relationship with. I meet with the CEO and her team on a regular basis, and they have a very specialized ability to build using a specific chip that we use on this particular device called an FPGA, which is kind of the super performing microprocessor that helps us do what we do. Overall, this is a great business and a great solution to be building for that business, and we're very excited to tell you more about that. So next slide, please. So just a bit about our companies. customer base, we have over 200 customers buying products from Napatech at any given time. About 70% of our revenue is based in the United States last year, and we expect that to continue to be the case moving forward. We have two kinds of primary customers. One customer is an OEM customer, and these are customers that buy our products and integrate it into their product line or solution and then sell it to the end user. These are technical companies that are building applications that run on servers, as you can imagine, either in the networking, network performance, and cybersecurity domains. And because they deploy their application with a server architecture, they need, at some point in time, they'll need something to make their service, their solution work faster. So all of these companies that you see here, and many more that we're not allowed to show you, basically take our SmartNIC and insert it into their server-based architecture along with their application and provide a higher performing application as a result. Their job in life is to be the leader within their respective marketplace. And what we do is we help them be the leader by providing a higher performing solution that they bring to the marketplace. You can see a few very key brands here. We'll talk a little bit more about them later. IBM, Cisco, Viavi, Pico, Nokia, all of these companies use our product in some way to accelerate applications they bring to their customers. We recently announced a relationship with Lenovo and Silicom as well, which I'll talk a little bit more about later. We consider the revenue we get from the OEMs as kind of our A++ revenue. The reason why we like revenue from the OEMs is because it takes time to win a design win in the OEM space. But once we get it, we typically have a revenue arc that lasts about 3 to 5 years and sometimes longer. Because these companies build us into their product line, they continue to use our product as they drive that product line into the marketplace. So it doesn't provide guaranteed revenue, but it provides a longer relationship of revenue, and it tends to be a very technical, deep relationship. So we do get an opportunity to get design wins with other product lines that they're also bringing to market. And that's a super great place for us to do business. So over 70% of our revenue comes from an OEM in 2020 in particular, and we expect that percentage to remain healthy and strong as we go into 2021 and beyond. The other kind of revenue we get is from an end user customer. These are customers that have projects where they have an application within a data center they have to deploy, and they're making a decision about which application it is and what is the performance vector that application has to perform at. Customers like this were building big data centers. Customers like Facebook or Citadel or Bank of America, Morgan Stanley, some of the pharmaceutical companies like Eli Lilly or Novo Nordisk, they build data centers and then they run applications on the data centers. And there's certain kinds of applications that just don't run well on a standard server. In that case, those companies look for SmartNICs, just like the ones that we provide to the OEM customers to help them accelerate apps. They have a choice. They can either deploy more servers to make the applications that they're deploying run better, or they can deploy less servers with SmartNICs embedded in them to horsepower those servers and use less floor space, less powering and conditioning, less energy, and get the same output of performance or even more output on performance. So these customers usually show up when they have a project to implement. They may implement the project over a couple of quarters and then they'll go away. And then when they have the next project, they'll come back to buy more. So it's a different kind of revenue arc. It tends to last for a shorter period of time. It tends to arrive in our pipeline in a shorter period of time. But it produces about 30% of our global revenue, and we expect it to stay that way going forward as well. Just in the middle of this slide, we're showing you a little bit about our key partners. We go to market through a number of different VAR relationships and channel partner relationships. But the three at the top are very strategic to us. There's the two on the left, Intel and Xilinx, are the two mega players in the FPGA domain. The FPGA is the super fast performing accelerating chip that we use on our product. And we buy those chips from Xilinx and Intel. They own about 90+% of the overall FPGA market, so they are absolute leaders. Obviously, they're huge brands within the marketplace too, and we have a strategic relationship with both of them. That strategic relationship is intended to give us the best-in-class technology, but get us access to the market as well. We've recently announced the addition of Acronix, who is a kind of a challenger FPGA maker to Intel and Xilinx, that has an innovative FPGA design, and we've entered into a partnership with Acronix to look for ways to use their technology and for them to use our software in their product line. The reason why these are important is because if we can make the FPGA do what it does, we're going to build a better product in the marketplace. So these key partnerships are very, very important. It's also very unusual for a company our size to have a relationship with more than one FPGA supplier because you have to move your software to run on those different architectures. But Napatech has designed its solution to do that quite well, and it's a unique advantage for Napatech. Next slide, please. So just to sum up what the problem is, I've mentioned it a couple of times, but I want to make it perfectly clear. Why do we exist? Why is there a market for a SmartNIC? And the chart at the left basically just sums up the situation very clearly. The server has a CPU in it, and every server ships with a CPU. But that CPU is not getting any faster. There's a tale in Silicon Valley around something called Moore's Law, where the CPU doubles in transistors and speed every 2 years at half the price, and that has really driven Silicon Valley to grow dramatically. It's kind of the fundamental tenet of Silicon Valley. But the reality is as CPUs get smaller and smaller and smaller, they're getting less and less performance at a higher cost, unfortunately, out of the CPU. And what's happening with the servers is the server CPU is beginning to level off. The other thing about the server is if it's a fundamental building block to any data center, any sort of deployment, servers can't be expensive. The goal of a server, it has to be cheaper. So you have two challenges here. The server has to be cheaper and the CPU is not getting any faster, but then it's going to be the foundation for running all of these intense CPU and intensive applications. So what do? You have this gap. Well, you fill the gap with a SmartNIC. You plug the SmartNIC into the CPU. Every single CPU has slots that allows you to insert these into the server, and then you put this into service within the server, and you move the application to run on the server, and suddenly you've increased the performance of the server dramatically. Less floor space, less power, less environmental conditioning, and you have a much faster performing data center with less servers. So the SmartNIC comes into the picture kind of at the right point in time when the market is highly dependent on the data center performance. Next slide, please. So I guess I don't have to tell you this. It's very obvious that everything is turning into an application that runs in the cloud or on a data center. Everything from applications, IT applications, security applications, but especially mobility applications as well. In fact, if you look at the mobile world, the 5G network itself is the first network that will be fully virtualized, meaning it is a set of applications that run on servers and lots of them. So we're just at the tip of the wave there, hopefully able to catch a market opportunity around the 5G networks, but there's plenty of other opportunities to accelerate applications as things are running on data centers. So our market follows very closely the health of the server market itself, because now servers are being deployed at massive scale in support of data centers, hyperscale data centers, and network deployments. And every single one of those servers is a physical addressable market because we fit in every one of those servers. Once again, those servers have to be low cost, and the less of them you buy, the better. So once again, the NIC market follows the server market very closely because it provides the horsepower necessary for those servers to perform very high CPU intensive kind of computing responsibilities for applications. So the NIC market is driven by the server expansion, and right now there's no end in sight. That's the way companies and enterprises build networks. So let me give you a sense for what that NIC market looks like. Next slide, please. So I've got just a couple of slides that summarize this. We like to show this to investors and prospective investors just to give you a sense of which market we sit in, and excuse me, and the viability of that market. Is it growing or not? And you can see in 2021, the market overall, the total NIC market, is expected to be about 2.9 billion and growing pretty rapidly to 5.6 billion by 2025. And the NIC market really is comprised of three different kinds of NICs, which I'll describe in just a moment. There's in a little more detail, the basic NIC, the offload NIC, and the programmable NIC. But if you look at the total NIC market and who plays in that market, you can see that on the right-hand side of this slide. The top 10 players in that market are massive companies like NVIDIA, like Intel, like Broadcom, who make some type of NIC and bring it to the market. But as you can see, Napatech shows up on the top 10 list. So you can see that there's a tremendous amount of consolidation at the top of the heap. But then the smaller players coming up from the bottom, and there's plenty of them in the other category, are working their way up into this market, and they're entering this market either through the offload NIC category or the programmable NIC category. So let me talk about which those categories are. The little blue box you see on the bottom of the stack chart is something called a basic NIC. These are super high volume, super low margin, super inexpensive NICs that perform a very, very basic function, and that's to allow networking between servers. It is highly consolidated around a particular industry player. In this case, it's Intel. In the marketplace, they own 80 or 90% of that market. It is not a market we focus on, and it's highly consolidated, and we're uninterested in that market, but it must exist. The offload market gets a little bit more interesting. The offload market performs a similar function to the smart NIC that we're building, but it performs that function in hardware. So the hardware is actually developed so that it performs a basic set of functions over and over again. It takes a long time to develop hardware to do that, but once you develop it, it becomes less expensive and it performs well over a long period of time. So there's a viable market for the offload market, but it's built in hardware using something called an ASIC. The programmable NIC by default is programmable, and therefore it's software driven. So the difference between the green bar and the orange bar is these are run by software, whereas the hardware NIC or the offload NIC is run by hardware. This is the market that we participate in. That is the one market that we're focused on, and that is where we're deriving all of our potential for growth, is in the programmable NIC market. And I'll show you a little bit more about the programmable NIC market on the next slide. So I go to next slide, please. So as you can see here, what I've shown you on the left-hand side of the slide is just the orange bar from the prior slide. It shows you kind of who are the key players in that market from the top to the bottom, and you immediately can see that Microsoft and Amazon are strangely within the programmable market. And there's a good reason for that. Microsoft, about 5 or 6 years ago, decided that it would compete with Amazon by building its own smart NIC within its data center to accelerate its applications and make their cloud-based infrastructure work more effectively. Excuse me. Just needed to clear my throat there. So Microsoft is actually a maker of a smart NIC. It's actually an FPGA smart NIC, but they only make it for their own use and they don't sell it. Amazon chose to do the same thing. Their purpose in life is to compete against Microsoft Azure by differentiating their services within their cloud. They acquired a company that is also a programmable NIC company, and they build, but they only consume it themselves. So we consider those two guys self-builds. So if you take those two guys out of the marketplace, you can see that Napatech fits kind of at the top of the heap behind Marvell and Broadcom and ahead of others within the programmable NIC market. The pie chart on the right-hand side gives you a sense of what that market looks like with the self-builds removed. So Napatech sits in a very interesting position as a challenger in that market, as one that's growing, looking for a way to expand itself further by leveraging the use of the FPGA-based smart NIC. And our goal is to continue to accelerate within this market. We're going to see market growth as well, but not all NICs perform all functions within that market. We got to focus the function that we develop on the NIC to meet the needs of the growing parts of the marketplace. But Napatech's been able to emerge as a significant named player in the programmable NIC market as well. And you see the market is a fast-growing marketplace. So we hope that that gives you some sense of comfort that we're not trying to steal share from others per se, although we'd love to do that. We're just looking to pick up our fair share of the market by leveraging the kinds of applications that we build and deploy. Next slide, please. Let's talk a little bit about the business. So from a historical perspective, and this is for 2020, we shared this in the Capital Markets Day presentation. We've been growing and been growing quite nicely. We report obviously as a Danish company in Danish kroner. We trade as on the Oslo Stock Exchange in Norwegian kroner, but we are a US-based revenue company. All of our products are priced in USD, and year over year we grew at 16% year over year in revenue in USD. Our margins continued to stay strong at 71.5% as expected. That's a very good sign for us because it's a demonstration that we're not having to discount our way to success as we grow the business. Our customers are giving us a lot of value for the features and functionality that our software provides in our product line. We are very happy to, for the first time in history, deliver not only an improved balance sheet, but strong earnings in the year as well. And that's a very important line that we crossed, profit and cash flow, and we continue to accelerate that in 2021. So next slide, please. So just underscoring some of the financial data that we shared in our most recent IMS, 10 quarters in a row of year-over-year growth, 4 quarters in a row of profit and growth, both of which are very important to us, and we continue to see the expectation to do so some more. In Q1, we grew at 6% year over year against a very tough compare, Q1 of last year. Gross margins remained very strong, and our EBITDA, and our earnings were significantly up year over year, even over last year. So we bring a business to the market that is doing well. It's growing, it's profitable, it's cash flow positive, and we believe that the prospects are positive for more of that as we get into the future. Next slide, please. So just to wrap things up a little bit, we are going to continue to announce key relationships that we build in the marketplace that we think are important to our customers. We just recently announced Lenovo and Silicom as new important players for a new product line that we're bringing to market around virtual networking. We just announced a relationship with Acronix, which is a new FPGA supplier that is a challenger to the Intels and the Xilinx of the world. We're doing very well in the fintech world, and we're growing in terms of the number of design wins. And I mentioned that earlier in the presentation. The more design wins you have, the better your long-term revenue prospects can become. So those are all very positive. Next slide, please. We're going to focus on a three-pronged strategy for growth. On the right-hand side, it's very clearly articulated. We're going to continue to expand our core product value, which is what we've been doing to grow our business over the last 5 or 6 years. But we're going to introduce new products that accelerate the growth in 2 areas. One is called inline, which is the ability to process packet flows in a more kind of inline fashion for higher speed, higher performance, and things for example, in the firewall market. And then we're also approaching the new market around virtual switching, which we believe will be a very significant new marketplace as 5G networks get fully evolved. So that's our three-pronged strategy. Next slide, please. So just to summarize our outlook, and we'll go to the slide right after that. One more slide, please. You can advance one more slide. Yeah, that one. We feel pretty good about our 2021 aspirations. We put annual guidance out, but just to give you a sense for what our growth vectors are looking like, we're very comfortable getting to a 20% growth rate. We're on track to fulfill those aspirations to get to the 20% growth rate by the end of 2021 over the aspirational period. We see 30% growth rate in 2022 and beyond. And as part of that, if you run the numbers, you can see $100 million in revenue within the 2024-2025 timeframe. So we have momentum, and we see no reason to believe that that momentum will shift in the wrong direction. The question is how well we can execute. We also expect margins to remain high at around 70%. That's a very good sign that we can grow the business and maintain our gross margins, and we've proven that over the last couple of years. Our operating costs, we're going to continue to keep low. It gives us plenty of opportunity to invest for growth. You can see that in the business. If you look at the business in history, we've been very good about cost structure and keeping the cost structure in place. But we're also building a software-only line of business that will also help us from a margin perspective, selling the software that we build on our SmartNIC that can run on others. So with that very last slide, just wanted to put the concepts on the table. We're a stable and growing company. We have cash flow, earnings, and revenue in an exciting market, building great new products and winning customer brands. And we hope this is a good investment prospect for our investors. So, Eric, I'll turn it back to you.
Thank you for Thank you for a very good presentation, Ray. We have time for a few questions, so we can start by looking into what are your thoughts around the OEM investments levels now in 2021, since you have seen some headwinds due to COVID-19, to my understanding. So if you can comment quickly on how does the visibility look like now, and have you talked to your OEM customers, and what are they saying? Thank you.
Yeah, the OEMs are going to continue to be strong for us in 2021, without a doubt. We do have a difficult compare in the first half of the year. Last year, COVID had a strange effect on our seasonality in 2020. We tended to perform a little bit more in the first half than expected, and we performed a little bit more normally in the second half of the year. And we would not expect anything major to change within our business related to our OEMs and overall business. We tend to do more business in the first half of the year with OEMs than with end user customers in the first half of the year. Most of our end user activity is in the second half of the year. But we have good visibility as always. We have pipeline visibility to our OEMs that go out about 6 months. We're not like a chip company. We don't get orders 1 or 2 years in advance. Our OEMs do place orders with us about 3 to 6 months in advance maximum. Right now, we're getting a sense that the OEMs are performing just as we would expect them to perform. A couple of variations. Not all OEMs are exactly the same. Some are a little better, some are a little worse, but overall, we anticipate that in our business plan. And so we feel pretty good about the development there. What's really exciting for us is what's happening in the second half. The second half is going to be dominated by continued OEM activity, which we normally would see, but also we're beginning to see some of the opportunities on the end user side. We don't have really strong visibility into the second half for end users when we're doing the business planning, because we just can't see out into that pipeline that far, but we have a pretty good expectation of what kinds of activities could occur, and we're beginning to see those develop. So I think 2021 is another good year for us.
Mm. And you also might see some developments in the Lenovo and Intel Xilinx partnerships. So have you seen anything there, and when can we expect to get some news flow around those partnerships?
Yeah, we'll keep the investors well aware with news flow as things develop, but there's a lot of activity with both of those guys and others. The way these design wins work, especially with companies like Lenovo and certainly with Silicom, is there's a fair amount of work that has to be done up front to bring the customer to market, and then there's a fair amount of work that they have to do to actually win their first customer wins. We work very closely with them throughout that entire process, obviously. Lenovo is in market. They are talking to certain customers, and the way things work in China is you tend to sell in the first half of the year, and you tend to reap the benefits of that in the second half of the year. And they have a very, very annualized buying cycle. So we're hopeful that we'll see some opportunities like that emerge in the second half of the year. We still have a ways to go. Like with any new line of business, it takes about 18 months to create revenue, but we'll see what we can do, and maybe we'll get lucky and get some revenue in 2021. Same with Silicom. Silicom is still a software a port over to their hardware solution that's based on the Intel hardware, and that work is underway as well. And we're optimistic, and we'll see what we can do to help them get revenue in 2021. So fingers crossed. We obviously would like to see it happen sooner than later.
Sounds very good. So I guess the next question would be then, since you have quite strong growth aspirations, so what would be the main risk for you to not reach that target for 2024, 2025 of $100 million?
Yeah, I mean, there's always risks in the marketplace. For example, the predominant risk in the market today is supply chain risk, not having sufficient component supply to build the products. That could be a challenge for us. But I think the risks are that we don't reach the market at the right time, and somehow, some way, we miss the window of opportunity to capture a piece of that significant market growth around 5G. But we think we're hitting the sweet spot in terms of timing. It's all about access to the market and then execution to close the business. We are competing with some pretty significant players out there, but we bring a very interesting prospect to the table. So there's a sales and marketing and there's a channel to market challenge for us. We continue to try to mitigate those by building our partnerships to a broader base of partners. And we think that that's going to serve us very well in the future.
Thank you, Ray. I see that we are out of time, but thank you for a very good presentation and good answers to my questions.
Thank you very much. I appreciate it. Thanks to everybody.